I think you hit a key point. Inflation, we always believe would be persistent and sticky. It's been our call for quite a while. And when you just look at a couple of the drivers of why we expected that, and inflation sticky in that 2.5 to 2.75% range, which was ahead of or above consensus. One big one was that real wages over the last 3 years, while they've been doing better, have not still caught up to the hit they took during the big inflation spike coming off of COVID. So our belief is that labor still has leverage, notwithstanding. Big debate about the softening of the job market, but we still see wages clicking along at 4% plus. And the second was, expecting tariff pass-through. We haven't seen that just in terms of the impact on inflation. We knew it would be delayed, but we are beginning to see signs that the pass-throughs are coming. We certainly, at least in the PPI number, which was a blockbuster number that we saw just a couple of weeks back. So sticky inflation at 3. Now we need to add in the impacts of the war. Obviously, everyone's focused on the price of oil and the impact that will have on inflation. The market is adjusting, it has adjusted to expect inflation higher. And so again, from our perspective, we always expected sticky inflation. We would notch up ours as well, a little bit. But I think as we stretch the lens back, 275 inflation, 250, 275 inflation as things settle down is really where we see the world that we're in and headed toward. And the market has adjusted to our view, prompted by the war. And even the Fed has. The Fed's recent meeting, you can see they're forecasting a spike in inflation again into that 2.7 area and taking a little while to come down. Fed is, quote, looking through, but all their inflation forecasts popped up. And even the market itself, where we were expecting a couple of eases this year, now backed off to no ease, perhaps, and even some out there that think a tightening is in the forecast. I think three important things for investors to be thinking about here. Even if the war ends in the next few weeks, which is what betting markets and the way the market's reacting is expecting, I think we're gonna see, again, the Fed agrees, inflation does stay sticky to the level that we think. Very importantly, number two, in those kinds of inflation environments throughout history, sticky inflation has caused a breakdown in the stock bond correlation. It's actually flipped the other way, and it's a much less durable combination as we've been used to over the last 15 years of stocks rally, bonds sell off, and vice versa. Not saying in a recession you wouldn't get value out of owning bonds, and you should own bonds. I'm not saying you shouldn't, but less durable. And so what that means is you have to be thinking about the bond market a little bit and the asset allocation a little bit differently. From a bond perspective, we have been arguing that rates are normalizing. And 450 10-year, we're just kind of right around that. That's not abnormal. We don't see it spiking crazy higher, barring any unforeseen circumstance. Again, nor do we see it rallying lower. That's a normal rate for the environment we're in, and that's just fine. Stocks can do quite well there. But while we're in this zone of trying to figure out what the war means for inflation, we would still caution to be sort of more in that intermediate part of the yield curve, where you're reducing that rate risk, but you're still earning very handsome yields in a positively sloped yield curve. So that would be one of the other things that we would point out to investors. And then I think in terms of stock allocations, diversification is very key. We'll probably hit this theme across some of the questions here. What types of stocks you're buying. We do like dividend payers and growers, seeking margins of safety and value, right? We're trying to break that chain of just beta stocks, beta bonds in this environment, and really looking at that's a very specific and deliberate allocations and thematic secular themes that regardless, I want to say almost regardless of the environment, will still have enough secular tailwind behind them to support a good investment case. You can just think, for instance, aerospace and defense. And certainly that complex is going to have billions and billions and trillions perhaps over time of new investment given the world that we're in. And then one final idea, it's a little bit of a counter trade right now. We've all been reading about private credit and credit, explosions in the markets. It's created a spook across retail for sure, wealth markets. It's really beaten up the public BDCs. The discounts are really quite large, and still would need to be very discerning and selective in what BDC manager you're looking at. But if you're looking at discounts of 20 and 25% in BDCs, and you do a very quick mathematical calculation as to what that implies for default rate, it's like 40% implied default rate. We didn't even see that in the global financial crisis. We are cautiously optimistic on the economy. Pretty sure we're not, in our view, we're going to have a GFC type event. And so they represent very strong value. We're going to have to stomach a little bit of volatility between here and there. But if you've got a little bit of a time horizon, they're probably a very powerful allocation within a portfolio.
Yeah, I think that it hits right on the key of kind of what we said. We've had a very good, durable theme as far as that goes, the steady inflation. And when you look at back past oil shocks, look at even the 22 little oil shock we had. If you look at the impact it had on what went on with oil in general, is really it spiked headline in the first quarter and a bit so the second quarter. Your overall impact was like a 50 to 65 basis point on average for those first two quarters. But then it suppressed dramatically the second half of the year. And when Cliff was talking about the duration, what they're pricing in, you kind of say, well, there's kind of a roadmap for it, which is why you're seeing such volatility in the oil. But the impact it had on interest rates, with that spike of inflation, we came into March pricing in roughly about two cuts by the October meeting. And now you're seeing that there was actually a half a point hike being priced in. So the bond market's trying to find its way. And you look at the 2 year and what it did, and it really kind of showed and represented that. So there was this flattening of the curve component to it, which is why when we're talking about this, when interest rates kind of get tethered, the correlation kind of breaks down. You really have to be very deliberate in where you're going as far as the inflationary front and so forth, because it does put the Fed on hold with a very pretty tight labor market. It hasn't really deteriorated like most thought it would. So I think when you look at it, the labor shock or the oil shocks and supply shocks, and typically what happens is this is going to kind of have a little bit of a duration to it. But when we look at it, some of these themes that are coming out, some of these opportunities that are being presented by this quake in this Mideast tension is actually pretty profound. And I think the private credit area actually is actually turning into probably one of the best opportunities if you have someone that's been around and been through these kind of processes in the past.
I think I'll just add, big picture, one of the points that we've been making is that the economic drivers or the market drivers behind the market are evolving. And, the point that we've been making is that most of the rate relief is probably in the rearview mirror, at least for now. But, I think the important things to keep in mind is that there's really attractive yields that are available just on an absolute basis. You're getting over 5% in investment grade, you're getting over 7% in high yield. That's going to be your long-term driver of returns in those fixed income markets. Spreads have held up really nicely despite the volatility and some of the uncertainty in the market. And I think most of those higher inflation expectations have already been priced in. So I do think it is a really good opportunity to lock in some pretty attractive yields.